And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Monday as we kick off this pre-Thanksgiving week. This is a big week coming up. We've got in Walmart earnings this week. Of course, we'll get a shot at the consumer. And then we've got Nvidia this week, the most important company in the world, will report earnings. So the market's going to pretty much trade around Nvidia's earnings this week. So this is, could be a really good week for the markets, or maybe not so much, depending on not just what the announcement is, but really what the outlook is. Outlooks for CapEx, outlook for chip sales, those type of things. Any, very positive comments about AI CapEx spending for them, that's going to be very good for the company. If not, then we could see this market sell off a bit. Again, there was some pressure last week, kind of pre-positioning for this Nvidia earnings announcement this week. So a lot of the pressure that we saw last week in the AI space, lots of headlines around is like, oh, there's, concerns over AI, et cetera. No, a lot of that was really just hedge funds kind of pre-positioning for Nvidia's earnings this week, because again, Nvidia is going to set the tone for the market one way or the other. So again, we'll see what happens, but again, be prepared for some volatility this week. This morning, Google is going to open up about 5% this morning as Berkshire Hathaway, Warren Buffett, announced that they were taking a stake in Google. So Google is going to have a very nice move today. It's going to be right up near all-time highs after that announcement. So again, it's kind of interesting, because I remember back in the late 90s, Warren Buffett would not invest in technology at all, because he's like, I don't understand tech, so I'm not going to invest in it. And then many years later, he bought Apple, and now he's bought Google. So the question is when does he buy Nvidia? That's going to be the real question. So when he buys Nvidia, this game's over. That's all I'm saying. So anyway, we'll see what happens today. Again, kind of the market setup for this week is going to be a little bit cautious. Next week, of course, is Thanksgiving week. So markets are going to be, open half a day, I believe, on Wednesday, and then closed on Thursday for the holidays, or maybe that's backwards, closed on Thursday, half a day on Friday. Either way, the market's going to be a much lighter trading week this week and next week. And again, markets tend to perform better. The week before Thanksgiving and the week after Thanksgiving, mostly because trading volume is light, kind of inmates running the asylum. Traders are already starting to leave for vacation, those type of things. Speaking of vacation, good news is that this week we will also have the end of the shutdown, and we'll get TSA workers back to work, and that will get travel. The travel snafu will kind of get behind us, and we'll get planes back on track. So if you're planning on traveling for Thanksgiving, good news is that at least through Christmas, you should be able to travel without long lines and consequences. So we'll see how this all works out. Coming up on the show this morning, we're going to talk a little bit about full market cycles. We're also going to talk a little bit about kind of the issue of an economic reacceleration. One of the kind of the key topics for next year is whether or not the economy will continue to grow again. So we're going to talk a little bit about that this morning. Just making the case for economic, the data right now suggests economic weakness, but we've got to make the case at least for the potential for economic reacceleration, because that's what Wall Street's expecting, and all the earnings estimates are currently banked on a reacceleration of economic growth next year, primarily due to CapEx spending. But again, we'll kind of get into that a little bit this morning. So with that all kind of behind us, let's talk a little bit about what happened last week with markets, what to expect this week. Here's what you need to know before the bell this morning. Markets came down, challenged the 50-day moving average again on Friday. This is the third test of the 50-day moving average that we've had since really kind of October the 8th. We've come down here, challenged this a couple of times. All three times, buyers have now stepped in and bought the markets. So we keep seeing these buyers step in at major support levels. We keep seeing that buy the dip mentality show up. We saw this again this Friday. So again, this morning, futures are pointing a little bit higher this morning, but again, it's kind of a weakish opening this morning. So we'll see if we can hang on to this 50-day moving average. If not, We do have some potential risk here, below us coming down to retest this low back on October the 8th, which is around 6,500. So there is some downside risk to markets this week. Certainly don't want to, kind of set aside that there's no risk. Again, a lot of this is going to depend on what happens with Nvidia when they report earnings this week. Upside resistance right now is around 6,900, which is right at this previous peak of all-time high. So we've got a fairly defined range where this market's trading right now. And again, as we kind of look at this, we've been, despite the fact that we did kind of temporarily break out of the markets, which was fine. We've really kind of been stuck now within kind of a trading range for a period of time here. So again, instead of this more angle, kind of this more rising ascent that we saw post Liberation Day sell-off, the market's really kind of started to stall up here. So two things here: we are consolidating within this recent run of the market, which is good. Technically, that's good. But this is also could be a topping process. Again, we don't know that just yet until this market makes a decisive move. But again, if we start to really kind of break down and really kind of watch this low from October the 8th, because that's not a very straight line. If I can kind of watch this low back on October the 8th, again, right around 6,500, as long as we can maintain within this level where markets are kind of in decent shape. But if we start breaking down below this and really kind of breaking down below this rising trend line to any significant degree, this is going to really kind of put a lot more downward pressure on the markets near term. So again, we are in a sell signal right now on a short-term basis. We are working off kind of relative strength as well. So, there's still some downward pressure here. I don't want to set that aside. So you do need to manage your risk. Again, we have a very important announcement this week, which will really set the tone for the markets. And then from a bullish perspective, we are moving into the end of the year. So we do have corporate buybacks back. We do have, a lot of kind of, momentum chasing at the market. Still have a lot of portfolio exposure to get worked up. Sentiment positioning by professional managers is fairly neutral. So again, that kind of gives an upside lift to the markets historically. But again, you can't dismiss this little short-term risk here. So there is some downside risk this week. Manage your exposures. But I would maintain a bit more of a bullish bias, at least through the end of the year, just because of some of the other seasonal dynamics. Again, we'll just navigate this as we go. But again, just don't kind of dismiss this risk. Let's see how the market plays out today, and then we'll update you tomorrow on kind of what to expect next. That's what you need to know before the bell this morning. We'll come back. We'll talk a little bit about economic reacceleration and full market cycles today on the show. So don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So some interesting comments in chat this morning talking a little bit about Berkshire Hathaway. Berkshire Hathaway has lagged the S&P 500 this year. Of course he has, because he's not invested in artificial intelligence. Well, until he bought Google over the weekend. But yeah, I mean, he's mostly financials and industrials. And yeah, those have lagged this year relative to AI. So yes, he is going to lag, particularly in that kind of a space. I would not count him out, though. Again, from a positioning perspective, this is kind of one of those companies you want to carry in your portfolio, just simply because when you do get a risk-off environment, he performs well. And with the opportunities he has with the cash he has, when we get a risk-off environment in the markets, you'll want to own Berkshire Hathaway. So again, it's always interesting to me when you're in the midst of this kind of bull market trend, and this was in the late 90s as well when we were in the dot-com crisis. As I said earlier, Berkshire Hathaway was like, we don't own tech because we don't understand it. Everyone's like, oh, you're like driving Dad's old Pontiac, right? You're so out of it. You're lagging the S&P 500. Yeah, he did until 2001 and 2, and he crushed it. So again, this is, I have seen many people throughout my career have doubted Warren Buffett and have paid the price for it. So just, be careful with your views around Berkshire Hathaway. We own Berkshire Hathaway in our portfolio simply for a defensive position. That's it. It's like owning bonds. So let's talk a little bit about kind of some of the views that's going on. So right now, earnings estimates are being revised up for next year. In fact, I just posted a couple of charts on Twitter this morning, just absolutely talking about this very same thing. That if you take a look at the outlook for next year by the S&P 500, by FactSet in particular, this is earnings sentiment for next year, which is rising fairly sharply right now, particularly for the U.S. Now, you're not seeing such an increase in earnings sentiment for international stocks, and this is why U.S. stocks will outperform international next year, most likely. You're talking about economic growth, according to the OECD, about 1% for the Eurozone, 2% for the U.S., and earnings revisions are going much higher in the U.S. than they are for the Eurozone because they simply are not growing the economy strong enough to support much stronger, economic growth rates. So again, economic growth rates are going to be important. And again, this is from FactSet. This is the actual bottom-up EPS estimates, at both actual and estimated for next year. And again, you're seeing these actually tick up fairly sharply going next year. Right now, FactSet's expecting $270 in earnings for 2025. And sometime between now and the end of eternity, Brent will get the chart up. There we go. In 2026, 306. So you're looking for a fairly substantial increase in earnings estimates for next year. So there's a lot of expectation that we're going to see earnings growth pick up next year to help support those kind of outlooks. And, this is going to be the real challenge for next year, because as you start looking at the outlooks, currently and talking about the current economic kind of situation, looking at, employment numbers have been softening. In fact, I've got a report on this coming out next week. You're looking at slower economic growth, but you're expecting a stronger rising trend of earnings next year. Well, earnings come from economic activity. So if earnings are going to increase next year, and if earnings are going to be anywhere close to what we're currently getting out of FactSet, which is, look, FactSet's always overly optimistic, so let's just put that out there. But if they are expecting stronger earnings growth next year, you have to and again, that's not just from FactSet, it's also from Goldman Sachs. If you're expecting that, you've got to have stronger economic growth. And so if you take a look at like Goldman Sachs, they've just recently, they've had a very, very sharp uptick in their economic outlook for next year. So saying that, we have to at least, give some credence to this idea, regardless of what your view is right now about the U.S. economy and what the markets are. We have to at least give a look at this idea of economic reacceleration, and just from a contrarian point of view, whether you agree with it or not is fine. And this isn't the point of the conversation. The point is what data is out there that would suggest or support this idea of economic reacceleration. So one is, looking at this idea. First of all, you've got a very large percentage of the economy that's controlled by the top 10% of income earners. They make up more than 50% of consumption right now. So again, this is important because consumption is the driver of the U.S. economy. 70% of the U.S. economy is driven by consumption. Well, you've got the top 10% of income earners pretty much driving 50% of the consumption in this environment today. So again, that's just, we keep looking at like credit card data spending. It continues to be robust. We take a look at, retail sales. They continue to be okay. So again, as long as that is maintained, then we should be able to maintain 2%-ish give or take, economic growth next year. That would be supportive of earnings, not to the degree that FactSet expects, but there is a degree of expectation there just from that you're going to have sustainable economic growth going into 2026, which will help support earnings. However, financial conditions are also fairly loose. That's also helping support economic activity. So, when you typically have tightening financial conditions, that is when you start getting downturns in markets, those type of things. Well, right now, financial conditions are getting looser. The Fed's cutting rates, plenty of liquidity in the markets. You've got the wealth effect from rising stock prices right now. So financial conditions are still very supportive of economic growth going into next year. The key question, though, is whether U.S. spending will catch down or will the labor market catch up. That's the key question here, because labor conditions, again, continue to remain weak. And we have to at least acknowledge that at this point. So one of the only real kind of weakness in U.S. data has been really in that labor market condition. And domestic spending has remained robust, again, despite the weakness in the labor market conditions. Leading indicators for employment, both PMIs, the NFIB, the Fed regional surveys, they remain weak. But disposable incomes right now are they are slowing down, but they're remaining stable enough to help support the environment. So again, when you start looking out what happens in the next year, you're looking at potentially that employment could catch up to spending as we start to see this CapEx spending into data center build-outs, those type of things, because that's going to require employment. So again, one of this kind of fiscal support for better free cash flows for corporates, the reshoring, and stronger kind of financial conditions in the U.S., that's going to all be kind of supportive of creating more employment next year. Again, because just all the infrastructure in general, you got to build the buildings, you've got to run the electrical grids, you've got to do all these things. So that's going to increase potentially employment. That should also help support wages, at least wage growth as we go into next year. And again, this is a composite index of the ISM, Manufacturing and Services Index. So again, roughly 70% of the economy is services, about 30% is manufacturing. So this is the composite index of manufacturing and services, weighted 70-30. And we're not in contraction mode. We're right at kind of contraction. But we've been consolidating here for quite a long period of time. This is very unusual. Usually the economy doesn't do this, but the economy's just been kind of muddling along now for the last couple of years. So the question is have we kind of consolidated? If you were going to say, the U.S. was going to have a recession, we kind of sort of been in one. According to these indexes, we've kind of been slopping around a recession now for a while, even though it's not an official one, which suggests that we may be getting closer to a re-upswing in the economy, particularly if this CapEx spending comes to fruition as expected. We could start to see, the economy start to pick up here a bit. Again, as I start to build out data centers, that requires more services. The services pick up. That's going to feed back into some of this data. Again, there's no guarantee of any of this, right? So mind you, this is all just looking at the contrarian point of view. I'm not making the case that this is absolutely going to happen. I'm just saying as an investor, we have to at least acknowledge that there is the potential for this to occur. And when you start talking about CapEx spending and these type of things, if that starts to feed through to the economy, that's going to lead to stronger earnings growth. We run an economic composite, which is comprised of all the Fed regional surveys, the Chicago Fed National Activity Index, the ISM indexes, the OECD indexes, the leading economic indicators, the NFIB. So this is a very, very broad indicator. It has more than 100 different data points in it. And that's seen a fairly sharp uptick over the course of the last month or so. So, we're not, and again, we're not seeing that drop off into recessionary territory by any stretch of the imagination. We're actually seeing more stability in some of the kind of the coincident data, despite the fact we're lacking a lot of government data right now. A lot of the coincident economic data has shown a little bit of relative strength. Again, we're not booming by any stretch of the imagination, But the point is that we're just not absolutely collapsing either. So, will you have weaker economic growth next year? Are we going to be, 4% economic growth next year? Probably not. But you're probably not going to have a recession either. So you're going to have so the point that, kind of the bottom line support is, or the kind of the bottom line point is that, as we move into next year, you're going to have enough economic growth potentially to help support earnings. In fact, one thing that FactSet had put out just recently in one of their discussions was talking about the forecast implied that the S&P 500 will look at about 8.5 to 9% earnings growth next year. That's it's better. It's still below current consensus, which suggests that a lot of that 270, 300 earnings estimates will have to come down somewhat. But you're still looking at 8.5 to 9% earnings growth next year, which will be strong enough to help support valuations where they currently are. So again, if you're expecting this big market rollover, it's fine. And again, we're going to talk about full market cycles here in a minute. But going into next year, just be a little bit cautious being too bearish, because there is some support here for earnings to be supported going into next year, simply because of the activity that's occurring with them, and at least the anticipated activity. Now, even if CapEx expectations are too high, and all of a sudden, Nvidia comes out and says, yeah, we're not going to spend $5 trillion on CapEx, or whatever the number is. We're only going to spend $2.5 trillion, or whatever that number is, right? Let's just say that all the CapEx gets cut in half. Okay, that's going to be very bad for the tech stocks, right? Because it's all based on forward outlooks, forward expectations. However, even at half the CapEx spending for next year, that's still going to help support economic activity. So if you're expecting a big recession, there is a case to be made that that's not going to be the case next year. So again, just bringing this back, it's just important to, regardless of what your view is for next year, to at least analyze both cases. Again, I've got an article coming out next Friday or Friday after next, talking about the employment situation. Employment's not good. Wage growth is declining. We're seeing weakness across the board. You've got delinquencies rising. You've got all these kind of things that are going on that certainly suggest weaker economic activity. And, will CapEx spending in AI data centers reverse all of that? Probably not. So, my outlook for next year is not nearly as robust as Goldman Sachs or FactSet or what a lot of these other companies are thinking. I'm thinking that the economy is going to have some trouble next year. Not recession. Not going to be booming, right? We're going to muddle through again. It'll be a much kind of like we saw this year, where the economy kind of grows and stabilizes. But I think that earnings are going to have a little bit more of a challenge reaching some of these more lofty estimates that are currently out there. Again, but as a portfolio manager, I have to look at both cases, and that's why I wrote this article on Friday talking about economic reacceleration, because it is a thesis, and it is one that you need to pay attention to, and it is one that could potentially be the case. So if it potentially turns out to be the case, we need to be able to adjust and manage our portfolios accordingly. Okay. Having said all that, let's get into the crux of today's conversation, because this is going to be a little bit more in depth. But we're in the midst of a very long bull market cycle, one of the longest in U.S. history. So it started in 2009. And we have not violated any bullish trends since 2009. It's been a very, very long secular bull cycle. So we're currently 15 years into this, 16 now. And normally, kind of these full market cycles, they can last around 20 years. So, we're at the longer end of one of these, what we call a secular cycle. Now, secular cycles are important to understand. Going back to 1900, you have secular bull markets and you have secular bear markets. And these are periods where markets trend positive. A secular market is when the price of the market trends in a direction over time. So if it's trending higher over a period of time, that's a secular bull market. If it's stagnating or declining over a long period of time, That's a secular bear market. And if you go back and look historically at markets, we cycle from one cycle to the other over time. And so you had from 1871 to 1901, you were in a secular bull market. From 1901 to basically about 1920, you were in a secular bear market. Then it was a bull, then it was a bear. Bull, bear, bull, bear, bull, bear. Well, now we're in a bull, right? And this all is a function of valuations over time. So when valuations are fairly cheap, that's typically where you end secular bear market periods and a bull market starts. And when valuations get very elevated, that's typically when bull markets end and bear markets begin. But again, this has been a very, very long secular bull market that we've been in. Now, forever, and again, to bring that chart back up real quick. But what's important to note is that, and this is kind of that purple dashed line, is that full market cycles encompass both. Because again, for every bull market, there has to be eventually a bear market. Bull markets don't last forever. Eventually, you're going to have a reset of some sort that corrects valuations. We go through a period of time where markets reset themselves, and this is regardless of Fed intervention or anything else. It's just how markets work. But when you go through one of these resets can last for quite a long period of time. And again, that doesn't necessarily mean that prices only go down. If you take a look from basically, after 1929, you got to, kind of 1933, and then the markets rebounded. But really, after 1929, the markets just went nowhere till 1948. They just very long period of time going sideways. The 60s and 70s, you saw, kind of a bigger decline situation. But again, you get the idea, right? 2000 to 2015, markets went nowhere. So these secular bear periods don't necessarily mean that prices just go down for 5 or 10 years, whatever they are. It just means that they just kind of go sideways. This is why we talk about periods of no return. You go back historically, look at 2000 through 2013 as an example. Your return was zero, right? A lot of volatility in between. Had some bull markets, had some bear markets on a cyclical basis. But again, your net return over 13 years was zero when you got to that point. So that's what a secular bull market is, just very, very low rates of return. It doesn't have to be negative. You got to have a 2% rate of return over 20 years, right? It's still a secular bear. So the point is that as, when you're in the middle of these secular bull market periods like we are today, it's easy to forget that the market has a full cycle to it. And that eventually you'll go through one of these periods where markets will just just gyrate sideways for a while. And there's going to be some big drawdowns, there'll be some rallies, there'll be some drawdowns, some rallies, drawdowns, some rallies. And at the end of 10 or 15 years, you go look back and go, wow, I made no money. But we're not there yet. But that is what is on the other side of this very long period of exceptional returns that investors have experienced over the last, 15 years. It's been a great market. It's been easy. Just throw money in markets, it just goes up. Here's a chart of the real S&P 500 index going back to 1871. Now, this is inflation adjusted price of the index. And what you'll notice is the red lines are these full market cycles. And what you'll notice is that from the beginning to the end of these full market cycles, you wind up basically where you start, despite the fact of all the great stuff that happened in between. So, for instance, at the end of 2008, you were back to where the peak of the market was in the 1960s, right? You just kind of wiped out all those gains. And that's what happens over time. And again, so if you take a look at where we are now and you kind of take a look at kind of historical tendencies, we'll wind up back at the peak of the market in 1999, 2000. In theory. Now, that's just in theory how it works. It doesn't mean it's going to work that way, but that's about 2,200, right, on an inflation-adjusted basis. So, that's a fairly substantial secular bear market if that occurs. But that's historically how things have happened, and I'm not making the case. I'm not saying that's what's going to happen. I'm not saying the markets are going to crash tomorrow and you're going to 2,200. I'm not saying that at all. I'm just saying, look, in normal full market cycles, this is what occurs. And again, you can end up higher. I mean, we could go through a secular bear market and, wind up exactly where we are today, right? But just 10 or 15 years out. And your return will be zero. That's the point is that these cycles tend to really weigh on long-term returns. And it's important to understand that these cycles do have a rhythm to them. And part of this is understanding kind of market structure. There's what's called the Wycoff cycle. And what the Wycoff cycle talks about is in these full market cycles, you go through kind of 4 phases. You go through the accumulation phase, you go through the markup phase, which is where we are now, and then you go through the distribution phase, and then ultimately you get back into the decline. So that would be the bear market side of this equation, right? So we're still in the bull market side of this. We're still obviously in the markup period because, right, we're just ramping up everything right now, marking everything higher. So we haven't got to that period to where we're starting to just stagnate, right? And we begin that distribution phase in the market. So we don't see the evidence of that just yet. But when you start seeing that early distribution, that's when you want to start being a little more conscious about your risk positioning. And we're, again, you just got to be careful with this. Understand this is very long. This doesn't happen overnight. These things take this. When you're talking about secular cycles, these are very long periods. This is a decade or more that this stuff occurs. Again, we're 15 years into the first half of the cycle. So again, very, very long. So you don't look at this chart and go, oh my gosh, Lance just said the markets are going to crash next year and it's all going to be over. I'm not saying that at all. Don't do that. Because the distribution phase could last several years by itself. And markets just kind of go up a little bit, they go down a little bit, they go up some more, they come down a little bit, and then you just see this distribution underneath the surface before you actually get into the decline phase. And that could last a couple of years. So again, this is not market timing stuff, right? We're just talking about understanding how market cycles work over time and understanding that there's a very long process to this. And I've just gotten, I've seen so many videos lately of people getting sent, people sending me videos. The AI bubble is going to pop. It's all going to be over. Markets are going to, crash, for this reason, that reason, other thing. And there's no evidence of that right now. You're very early into this whole AI adoption phase. Right? If you go back to the 1990s when we were adopting.com, that was a 5-6 year phase. So this AI adoption phase can, sitting there calling the top to AI here is a bit of a fool's game because you don't know. If AI is going to get adopted the way that everybody expects it to be adopted, if you're having all this AI capex, this cycle could last for 2-3 more years before you eventually get to the real crux, right, of AI. Is it going to work or is it not? We're not going to know that next year. We may not know that for a couple more years, right? And a lot of people are pointing to the, Oracle put on all this debt to go build a data center. Yeah, they did. Credit spreads are going up. That's an early warning sign it's all going to crash. Be careful with that. That stuff takes time, right? It may be in a little bit of a short term. You may be getting some volatility, but there's no evidence of major cracks in the system right now. So again, it's stuff we definitely pay attention to, right? I'm not saying don't pay attention to that stuff. You should. But just don't extrapolate it to mean that something's going to happen tomorrow because that's not what that data suggests. So coming back to kind of our analysis, let's go look at some full market cycles, just to kind of get some understanding of context. So this is 1992 through 2003. See, this is the point I'm trying to make about the markup and distribution phase. The accumulation phase occurred from 1992 through 1995, and from 1995 to 2000, you had the markup phase, right? And then the distribution phase started occurring, and that lasted a couple of years. It lasted through 2001 before you really got into the decline phase of the market. So again, my point is that these can last for a while. When you start getting into the distribution phase, you start getting a lot more choppy in the markets. Markets can still be making gains, but you're getting a lot more volatility pickup. Let's take a look at another one here. This is 2003 through 2009. You see the same type of cycle accumulation. You see the markup going into 2007. You got the distribution phase, and then Lehman files for bankruptcy, and you get your decline. But these cycles, again, they're very apparent, and we're not, again, we're clearly still in the markup phase right now. If you take a look at, this is 2010 through 2025, where we are now, you got your accumulation, and you've had this big markup now that started in 2020. So we've not started that distribution phase yet. And again, if you take a look back at those previous charts, that distribution phase can last a couple of years. So again, just be a little bit cautious, with your, being overly bearish with markets. And this is kind of the thing that becomes most important about managing money is we have to navigate the market that we have right now. And it's great to have these views that are bullish or bearish about the future. If you're ravenously bullish, that's awesome. Just understand it will end. If you're mega bearish, just understand that the bullish case has a lot of tailwind to it right now, and that bullish tailwind can last a lot longer. So, if you're trying to short the market and do a lot of things like that, it may not work out well for you right now. Eventually, it may pay off, but you can lose a lot of money between now and then being short this market right now, simply because of momentum, buybacks, all the other things that are going on. Eventually, you'll be right. And that's what the market tells us, is that historically, we're going to go through a period where, again, returns are going to be very low. This is a long-term chart. This is the real return, inflation-adjusted return of $1,000 investments with dollar cost averaging. So it's just assuming you're dollar cost averaging into your portfolio every single month, right? Going back to 1900. Even with that, you had very long periods, 6 years, 15 years, 12 years, 13 years of no returns, even with dollar cost averaging. So again, you look at that chart and go, well, yeah, but if you just stayed invested the whole time, you did great. Yeah, the problem is you don't live 125 years. So it's important to understand where you start. So if you're starting today, as an example, with valuations where they are, you run the real risk of having a 10 or 12 year period where returns are near zero. And that will certainly hamper your retirement planning outcome. So you can't ignore fundamentals, right? You can't ignore valuations. But what's really, really important is to understand full market cycles. And again, this isn't timing. You can't time with this. You cannot use valuations as a timing metric. It'll completely wipe you out. So this isn't a market timing conversation. This is understanding how market cycles work. Incorporate that market cycle idea into your investment policy to help you manage risk over time. And again, this kind of goes back to our conversation earlier about Berkshire Hathaway. Berkshire Hathaway's like driving the Dad's old Pontiac. Warren Buffett's lost his touch, right? He's underperformed the last few years. Yeah, of course he has. You want to bet against that man when the market does turn? Just a question. Sometimes you own assets in your portfolio that don't make a lot of sense today. I should just have everything in AI stocks. I'd be making a killing. But if I do that, when you get a downturn, you get wiped out. My goal is to preserve capital over time. I want to win the long-term game. I want to grow my assets today because I want to win the long-term game tomorrow. And survivability is what's so important. It's okay to be right during the first half of a full market cycle, but it will be the death of you to be wrong during the second half. There was a really great quote. John Hussman once wrote this, and it's important because he's right. It says, put simply, most apparent opportunities to obtain investment returns above zero in conventional assets over the coming decade are based on a misunderstanding of valuations. Total returns and historical yield relationships. At current valuations, virtually everything is priced for a decade of zero. The unwinding of these speculative extremes is likely to be chaotic and will likely occur over a shorter horizon than investors imagine. That chaos, driven not by central bank tightening, but by an emerging default cycle, will usher in fresh investment opportunities in conventional assets where presently there are none. Looking beyond the near term, my view is that a permanently high plateau is unlikely, and we will instead see a violent unwinding of recent speculative extremes over the completion of the current market cycle. Even if central banks ease aggressively, as they did in 2000, 2002, 2007 to 2009, corporate income growth and profit margins will narrow. He concludes that saying the completion of this cycle won't arrive because of central banks suddenly becoming enlightened enough to abandon their recklessness, because they won't. It will arrive precisely because they have sustained yield-seeking speculation for far too long already, and because they have amplified the vulnerability of the debt and equity markets to normal economic fluctuations, and because the consequences of this fragility are now fully baked into the cake. That is the important thing. Now, he wrote this a while back, and he was wrong at the time. But what he says is correct. The problem with the markets, and again, when he wrote this was several years ago. He wrote this, and he's been wrong for several years because of how markets work. And again, market dynamics, momentum, too much money chasing too few assets, those type of things can drive bull markets for a very, very long time. And that's the important part of understanding the full market cycle. It will eventually end. What causes it to end, we don't know. But they do end. And the question is can you survive when that occurs? And will you know what to watch for? And this is why understanding accumulation, distribution, markup, distribution, decline, understanding that cycle of the markets is so important, because it repeats in the markets over and over and over again throughout time. And it's going to happen again. Again, we're still in the market phase, but again, that will eventually come to an end. So, this is what's important to understand. Again, it has nothing to do with timing. This is nothing you can apply to your portfolio today. This is nothing out here that says you should go out and sell a whole bunch of stuff because Lance said full market cycles are coming. No, that's not the point of any of this conversation. It's just to understand how markets work over time and to be cognizant of how valuations do work over time. We do have high valuations, but we still have economic growth. We still have earnings growth. We still have a lot of things that are supportive of markets, so valuations remain elevated for a while. But if something happens, that's where you have to manage that risk. Okay, enough of that. So, coming up this week, again, we've got Nvidia earnings. We've got Walmart earnings this week. On Friday, we'll have another article out on Friday to kind of pick up. I'm kind of writing a whole series of articles right now, so we'll have another kind of a pickup on this on Friday as well. But again, we're in a good position right now for the markets. We've seen some pullback in risk assets. Bitcoin's been under pressure. We've seen a lot of the previous kind of markup in some of these areas kind of got a little bit of relief valve to them. So we've pulled back some of these assets. Risk positioning has come down a bit over the last couple of weeks. That's good. So, we're still set up for kind of this year-end push. So again, as I said earlier in the show, kind of during the morning commentary, we're still set up for this market to perform okay through the end of the year. Again, earnings still okay. Economic data still okay. Starting next week, we're going to start getting a lot of the economic data. We'll probably never see the October employment report because the BLS wasn't able to do their phone surveys. So we'll see the September report, I think, on Thursday of this week. So we'll see the September report. We won't see October, and then we'll pick up when we get to early December. We'll get the November report. So we'll kind of get back on track with some of the economic data. But again, we're going to get a whole deluge. Once the government reopens, we'll get a whole deluge of retail sales reports and all these other type of reports that have been embargoed. we'll get all that data. So we're going to get a whole rush of data here over the next few weeks. We'll have to go through and figure. But, the point of that is that could certainly lead to some short-term market volatility across all assets. Because, again, there's so much of this data is going to hit. Markets are going to be adjusting, trying to figure out Fed policy, what the Fed's going to do next. Is the Fed going to, cut, raise, pause, whatever. So, again, be prepared that we could see a good bit of volatility over the course of the next few weeks, particularly given the fact that we're going to be in a holiday shortened trading period, as well as lighter trading volumes. So, want to have a little bit of hedging in your portfolios, take a little bit of profits, rebalance risk, whatever you need to do. But again, once we'll get through this, we'll have a much better picture of kind of what to start to expecting for 2026. Okay, that wraps up the show for today. We'll be back tomorrow with John Penn for Two Deads on Money. And, of course, get by the website, realinvestmentadvice.com. Both these articles, Full Market Cycles, as well as today's article, is on the website now, realinvestmentadvice.com. Be sure to like and subscribe to the channel. It certainly helps us very much. We've got some great interviews for you coming up, as well as our continued interview series, and a lot of things coming for you. So it's all at the realinvestmentadvice.com website and right here on YouTube. Be sure to like and subscribe, really. Like, subscribe, do that multiple times. Thank you. See you tomorrow.